Part 2 of borrowing from your 401k to improve your household balance sheet. Welcome back, my friends. Thanks again for coming to part 2 of looking at the academic study and some of the research that's been done. And not much has been done, actually, which is unfortunate. Now, this is back in 2010, this paper. So there has been more done just by your old buddy Josh in my book, Strategic Money Planning. Shameless plug. But anyway, there has been more research done since 2010 when these folks did this. But let's dive right into it. Don't forget to subscribe down below. And, of course, thumbs up, comments, the whole thing helped me immensely as I turn my cell phone off from a solicitor. I thought they weren't supposed to solicit on your cell phone. All right, so this table just kind of tells us the interesting about 401k plans and loans going from 1992 to 2007. And you can see in 1992, 1/3 of the population had a 401k plan. In 2007 is half. And I can almost guarantee you this number has increased as the number of pensions have gone down, almost a direct inverse correlation. One goes up, the other goes down. And I can almost tell you that's what's happening here. How many people can take a loan? Well, back then, 20% of the people who had a 401k could. Now it's 34%. And how many people actually had a loan? Back then it's 2.3%. And now it's doubled to 5.1%. That's in 2007. Loan rate among all 401k participants, 10.5%. And then the loan rate among loan eligible participants, about 15%. So it's been higher for sure than it was back in 1992, but still relatively on the small side when you think about it. Back now, 2007. 15% of all eligible households had a 401k loan, so not a significant amount. I think they say, let's see, that we do talk about how much let's see, I thought they said, maybe I didn't do it. They talked about the average balance on it was like 4,000. I think we see it in here. Let's see. So here's the characteristics of the loan eligible households. Median net worth of without loans was 144. Median net worth with loans was 111,000. You can kind of, I'm not going to read all this to you. Anyway, it's kind of interesting. There's something else they were talking about, which I think we get into about the people who actually have a 401k loan. Yeah, right here. The finding of higher debt among 401k borrowers suggests that households tend to use 401k loans in addition rather than instead of other debt financing. So they have other financing and they use their 401k loans in addition to that. All right. So, for example, some households may have turned to 401k loans after exhausting other financing options. To test this, we explore whether the 401k borrowers are more likely to show liquidity in borrowing constraints. That means they don't have any borrowing power or a liquidity. And they would create several different indicators for each household. The findings of higher debt, lower net worth, and higher prevalence of liquidity and borrowing constraints among 401k borrowers indicate that 401k loans are more heavily used by households that have already used basically all their sources of outside borrowing opportunities. 401k, i.e. that 401k loans are among the last rather than the first sources for borrowing for households seeking financing. That's the problem here. So the problem is 401k loans are neither bad nor good. Annuity is bad nor good. A firearm is neither bad or good. People use them badly. And so in this case, you have a idea that if you're a 401k borrower, you're one step removed from going to the pauper. Becoming a pauper. Well, the problem with that is that's probably true, but it's probably true not because the 401k loan put you there, like Dave Ramsey would say about a reverse mortgage. It's probably true because you're spending too much and you've blown through all your other spending, credit card, equity lines, and whatnot. Now you're looking at the 401k loan as the last resort. If you see me looking over there, my wife texts me always because I got to make sure she's not in trouble. All right, so we're going to talk about the models that they use here. This is where it gets pretty interesting. Let's just keep going down. All right, right here. The finding of higher did I already use that to test it? Okay, I already said that. The findings of higher more heavily. Okay, yeah, we already did that one. All right. Oh, I must have gone up. I should have gone up instead of going down. So let's keep going down here. Bear with me just a second. There's more stuff. More stuff's coming. Don't you worry, my friends. Just got to find the right page. Right there. Blink. There we go. There we go. All right. Keep going down. There's a bunch of, and this is all the stuff you can right here. All right. All right. So first, we see that loans are relatively small. The median outstanding balance on the 401k loans in 2007 was about $3,700. By comparison, the median consumer debt in the sample was, and I think the sample was like 5,800 people, was about $2,100. All right. So it just shows you the people borrowing from the 401k borrow a whole lot less than they borrow for consumer debt. And you think it's because they don't have enough money in their 401k and wish to borrow. That's still not true. What happens is they look at the longevity or the tenure of someone with a 401k loan, and most of those people have been at their company more than 10 years, which has allowed them to consolidate or I guess accumulate a pretty significant amount of money in their 401k. So here's the tables of loan detail. Loan balance is $3,700 on average. Median, excuse me, not average. The annual payment is about $1,600. The months to pay off about 2 years, and only 27% of the people are utilized, or only 27% of the available amount is being borrowed against. That's the utilization rate. The number one reason is bills and debt consolidation. The number one reason, all right? 12% is only medical or educational expenses. I always find that funny because people say, we're one paycheck away from health costs making us go bankrupt. No, just not true. But if you're pushing for single payer, that is what you're going to argue on to make people scared that you're just one paycheck away from being a pauper because of medical. It's not true. That doesn't mean we don't have single payer. I'm against single payer 100%. In fact, I was just reading an article. They're pushing single payer and going to eliminate private insurance. That's a strike against freedom, my friends. So that's bad news. All right. So as discussed above, the opportunity cost of a 401k loan includes the foregone return on an account assets and any transaction costs. We assume a $50 transaction fee for the loan. We net this assumed fee out of all of our calculations of potential savings reported below. The value of the foregone return will generally be uncertain at the time the loan is made because we don't know what the returns of the market is going to be. To value this opportunity cost, we proceed with two steps. First, we use survey questions on 401k portfolio allocation to estimate the share of each 401k account invested in stocks versus fixed income, which we treat as bonds, which is ours. Secondly, we apply a variety of alternative expected return assumptions to these components to value the opportunity cost. Because the opportunity cost is so fundamental to valuing the potential gains of taking a 401k loan, we construct 4 different opportunity cost measures, each based on different assumptions of rates of return. Let me just share what's going on here. They're saying at the end of the day, when you're borrowing against your 401k, the number one thing, other than a small fee, the $50 or $100 fee, is you aren't going to have that money in the market generating returns for you. That's the number one opportunity cost. The number one reason you should not borrow against a 401k is because of that. All things being equal, regardless of not being laid off, the whole thing, is you think you're going to get more rates of return on the markets than you could on the interest that you're paying literally to yourself. But how do we anticipate that? We don't know what's going to be. So we're looking at 4 different scenarios here, which is pretty interesting. Our first measure applies typical long-term averages of stocks and bonds, in our case 10% for stocks and 7% for bonds. This type of long-term average is often used to predict future returns over long periods of time, though this approach may be less appropriate for short-term forecasting, which is 5 years, because that's the length of a 401k loan. Moreover, this measure is not a function of current or recent market conditions. As a second measure, part 2, we apply a 5-year trailing average of stock and bond returns. This approach is a function of current and recent market conditions, and we use it as a proxy for the type of forecasting that households might actually do in making near-term financial decisions. Though, of course, it does not account for any forward-looking information how households might use in forecasting expected returns. Yeah. So they're basically saying, hey, the last 5 years is what you did. We're going to say that would be what you get in the next 5. What does that look like? Our third measure is a direct indicator of household expectations, which is the median response to the Gallup survey about expected stock returns. Stock and bond returns. Our fourth is simply to use the risk-free rate of return as a measure of risk-adjusted expected stock and bond returns to partially adjust for the uncertainty of future stock returns. The 4 measures and the return assumptions is summarized in this table down here. So here's the 4 measures right here and right here. Long-term, 5-year trailing, Gallup survey, and risk-free rate of return. So the expected stock return is 10.5 over the long term. 5-year trailing was 5.2. Expected bond return was 4.4 over the trailing 5. This is the one I like most. Remember, this was written in 2010, and I like this. Your expected stock return is 5.2. Expected bond is a little bit higher than what I expect, but still expected portfolio return of 5% over the next 5 years. I think that's the best way to look at for sure. Now, if we look at the long term, it's going to be different. All right, 9% expected rate of return. A Gallup survey is 6.7. And the risk-free rate, that's probably that's a little bit higher than I'd like, but we can say a long-term bond, a 30-year treasury bond right there. I like the trailing 5 years, and I can see the Gallup survey as well. But all right. For each of the 4 expected certain return measures, we search for the SCF households who carry consumer debt at rates in excess of the resulting measure of opportunity cost, who have unused 401k loan capacity, i.e., they have high consumer loan debt and they have the ability to borrow against that 401k because they have unused 401k loan capacity to pay off that high consumer debt. First, we calculate the share of 401k loan eligible households that meet these criteria. Then we calculate how much consumer debt they could shift to a 401k loan, assuming they start with the highest rate debt first and going until either their higher cost consumer debt is completely replaced by the 401k or the 401k loan is reached. We measure the shiftable amount in aggregate for an average household and relative to total debt for the average household. Finally, we estimate the net interest savings from the shift. The interest saving less expected foregone 401k return and the transaction cost. So essentially, that's what I'm talking about. They're arbitraging. So here's your opportunity cost of 401ks. You're going to get 20% rate of return on your market, and you're only paying yourself 4% back. That would be the opportunity cost, or the other way around, based on these numbers right here. And then that would accrue over the following 3 years. We estimate both the aggregate net gain and the average across households, as shown in Table 7. So we already talked about this Table 7. So let's keep going down. Now, the drawback I have is they don't show what the 401k balance will look like after 5 years. And I think that's a mistake. And I actually do that in my book, Strategic Money Planning, 8 Easy Ways to Get Your Financial House in Order. You can buy it on Amazon. Did I tell you that? Here's where it gets interesting. Percentage of households who would gain from borrowing money from their 401k to pay off higher consumer loan debt. If we have the long run average, which again was roughly a 9% rate of return on the portfolio, less than half of the households would gain because they're having a higher projected rates of return on the market. So we don't want to pull higher return market returns out in order to pay off consumer loan debt. We don't want to do that if you think the markets are going to give you 9%. I like the trailing 5 years because trailing 5 year I think is more reasonable to today's numbers, and I'd even say it's a little bit higher simply because they're using a 4.4 on the bond. And they say 64% of the people would benefit by switching out. This is making money now. This is increasing your net worth. If we have the trailing 5 years, in this case is about a 5% total rate of return on your 50-50 stock to bond portfolio, they think at the end of the day, well, they don't think, they say 64%, so 2/3 of every, 2 out of every 3 people will benefit, increase their net worth by borrowing from their 401k in order to pay down debt. How much would they save? They'd say on average $700 or $800, $791. They would save $791 per person, or $5.8 billion over the course of those 3 years. Net savings over the next 3 years, $5.8 billion, which is $800 per person. That's real money, my friend. You might $800, divide that by 3. That's $275 a year. You might think that's no big deal. Combined by so many people, and that's the average. That's not the median. That's the average. So some are going to do more. In fact, they have a 90th percentile. The average person, the 90th percentile, will save $1,850, almost $700 a year. Billions of dollars, my friends. Maybe I'll title this report that how a 401k loan can save us billions of dollars. Let's keep going down. This is interesting right here. All right, so this right here, realized outcomes. So basically what's going on here is they say, okay, if you borrowed in 1995 or 1998 or 2001 or 2004, what would have happened in real terms? And this is where it gets interesting. So we're using 4 scenarios. You borrow in 1995. Well, the actual returns on the markets were 24.9%. If you borrowed in 1998, the actual returns on the markets were 1% over the next 3 years. 2001 is 3.5 and 2004 is 8.2. All right. So if you borrowed, your success rate in 1995, only 29% of the people would have made money having borrowed against their 401k to pay off higher consumer debt. Why? Because the next 3 years, they had an average of 24.9% rate of return. However, 100%, if you borrowed in 1998, 100% of you all would have made money. That's a fact, and big money. In 2001, 100% of you all would have made money and big money. In 2004, the long run average, you see, 99%, 100%, 74 is 74. So basically, basically 8 in 10, if you will. So of the 4 different scenarios, one of them was 100% would have made money. A second one, 99 out of 100 people made money. And the other two, 74% of the people would have made money. So basically, in all scenarios, under 3 of the 4 models, you would have made money. The only time you did not make money was in 1995 when the markets were taken off, i.e. irrational exuberance, to quote Alan Greenspan from 1995 on forward. Your net savings over these years in 1998, the average, this is just the average, you would have saved $1,200, over $1,000 if you would have borrowed in 1998 in a case of low preceding returns. In 2001, you would have saved on average it's about $900, and in 2004, you would have saved on average about $500 or so. All right, so that's real money over the next 3 years savings. You would have made money and saved money as well because of you borrowed against your 401k in 3 of the 4 years. In 1995, you would have lost $300. Basically, you would have lost on average probably $400. So in 3 of the 4 years, you would have made pretty good money. In 1 of the years, you would have lost $400. That's a trade I'll take. All right, so conclusion. We find that about half of our sample of loan-eligible households could benefit from using 401k loans instead of carrying consumer debt. And they could profitably shift about half their consumer debt, saving an average of $200 to $300 per year on net, or 10 to 15% of the annual interest cost. We find that households that do not hold 401k loans have more debt. We find that households that do have 401k loans have more debt, fewer non-401k assets, and higher incidence of liquidity and borrowing constraints than households without 401k loans, suggesting that households tend to use their 401k loans as a borrower of last resort, which they should use it first. That's it, my friends. So I'm going to go on the whiteboard now. So stay tuned. We're going to go on the whiteboard. I'm going to draw you exactly what I came up with, which confirms what these folks wrote about from my book. And I'll show you the charts, exactly how this focuses when we're using a credit card. And we're going to show how the money will grow better in a 401k as well. So we'll show you here in terms of why you should increase your net worth by borrowing from your 401k. Subscribe, hang out there, and we'll see you here in just a second. And then thumbs up and comments too. Thanks, guys.